just got into the if people just have gotten into multifamily in the last, say, 3 to 5 years, really don't have a perspective of what it was back 10 years ago, 20 years ago, 30 years ago, and for me, up to 40 years ago. And so what I'm going to try to do is just kind of paint a picture for you to kind of understand where we're at. So, if people don't understand kind of history and some of the fallbacks of what has happened, especially in banking and in finance and in real estate, as they say, they may be doomed to relive them again. So I want to kind of put a picture in your mind of what has happened. And I want to go back a long ways. And again, you can interrupt me at any time because I'll be your teacher tonight. And just kind of talk a little bit about it. So if there's ever a hand that jumps up there and you want to ask a question, maybe jump in, because this is not just me talking. I want to answer as many questions as I can about what went on. So if you go back to like 1981, 82, interest rates today, if you looked with your local banks, prime rate is about 8.5%. It's not 3.5%, not 4.5%, but it's 8.5%. So if you're going to get a loan from a bank, you start off at 8.5% because that's prime rate for their best customers. So it could be prime plus 1, so you're paying 9.5%. But if you went back, say, in 1981, 1982, any idea at that period of time where interest rates were? Edward, do you remember back in 1981, 82, where interest rates were at that period of time?
No, but I thought I heard someone say a while ago it was like 11, 12%. Am I wrong?
Good
Way off?
guess. So prime rate around that period of time, going to 82, 83, we're going through a large recession at that period of time. I was coming out of college looking for a job, and interest rates were not at 6 or 7, 8, 10, 11% like say they are today. They were at 21%. Prime rate was at 21%. So that was a huge deal. And if your parents were buying homes at that period of time, they were probably paying 15, 16, 17% on their home mortgages. So, interest rates then were huge. And so the economy was starting to shut down. And so during that period of time, we had the deregulation of a lot of industries. If you go back, it was like kind of the oil and gas business. It was the aviation business. It was Ma Bell that was being broken up into pieces. And so the huge amount of deregulation going on in the economy just to get things stimulated. And what they want to do is kind of send workers back because people were losing jobs, and they wanted to make sure the trades were busy. And those are the plumbers, the roofers, the electricians. And what could they do? Well, they could build apartment buildings. And so from 1981 to say 1985, going to 1986, we had a huge amount of apartments, huge amount of inventory being built. And I'm just going to pick on the Southwest, especially in Texas. We had lots of apartments being built. And a lot of these guys that are on this call are from Texas, from North Texas. So I'm just going to kind of pick on that area. In North Texas, we have a thing called the I-30 corridor, which goes from 75 and 635 all the way out to Rockwall on 30. And it was that period of time that a lot of apartment buildings were being built. And the kind of the philosophy was at that period of time to bring all these trades together so they could work on these properties and people could be, earning a decent wage, is build it and they will come. So they built lots and lots of apartments. So if you ever drive on 635 and you're headed over to Rockwall, look over to your south on 635 and you will see thousands and thousands of units. But in 1985, I'll get back to that one in a second, a lot of those people didn't show up. And so they were flipping properties back and forth between the builders and other people. The banks were involved. They took sometimes an equity position in these transactions. Names that you may not be familiar with, I would say Don Dixon is a name. He owned a company called a bank out of Northwest Texas, right towards Wichita Falls. It's going to come to me in 1 second. And so he came down and he started a savings and loan because he was a builder before, and he hated to go to the bank to beg for money. So this was a period of time of deregulation. So he bought a bank, and then he became the decision maker almost for himself to actually give himself some loans. And so what we found at that period of time, there's a huge amount of growth going on in Texas, huge amount of apartment buildings were being built, and we were starting to overheat the economy. That period of time, 86 going to 87, we had the tax law change that said, hey, listen, all this passive losses that you were taking. So if you put $100,000 in, it really wasn't 100,000, maybe it was a $25,000 investment into a partnership. You could probably take off the $25,000 off as a loss off your income. And so people who were making, say, $60,000 a year were taking $25,000 off, just like that bonus depreciation. And at that period of time, they were being taxed on that lower amount. And so the government stepped in and said, whoa, you can't do any of that anymore. So in 1987, we had a huge amount of tax changes at that period of time. And so they kind of stopped or slowed down apartment building now, but they were left with all this inventory of apartments on that 635 corridor as an example. And then what happened was, they built it and nobody showed. And it just didn't have to be 635. We had a bunch of properties that went into foreclosure, and the banks that had taken them over were sick banks already, and they were taken over by the FSLIC that then became the FDIC. And a lot of these banks were swallowed up, and the assets were brought over to the RTC, Resolution Trust Company, and that they were kind of the asset managers for the government to kind of figure out how they could get rid of these properties. And so what we had was a lot of these properties over on 635, because there was so much inventory, they didn't want to maintain them anymore. So these were brand new apartment buildings. They put a fence around it, and after a while they decided, hey, listen, we can't afford to maintain these properties anymore. So they put bulldozers through them, and they burned them down. So we had a bunch of properties on 635. You can see cement foundations that were still there, are still there today, on apartment buildings that were taken down. So that's a little bit of what had happened between, say, 1981 to 1987. And then the banks shut down. And at that period of time in 1987 to 1992, there was no lending going on in Texas. And then from 1995 or 1996, we started to rebuild apartment buildings, because we started to have enough balance in inventory versus supply and demand. And so then we started to build properties. And so you see a big gap, I would say, of construction from 1987 till about 1995. And then after that, we started to turn on, and there was banking and lending at that period of time. All right, I've talked a little bit. Any questions that had come up?
Oh, thank you, Paul. That is some good
Yeah.
back.
I have a question. Sorry, go ahead, Herb.
Oh, go ahead with your question.
Okay, so my question is, Paul, for you, that you're giving it thanks for giving us a history of the
Sure.
87, right? But, the inflation, the price per unit, per door, as compared to today, as compared to 87, is a big difference, right? Inflation is also playing a role right now. Now, what was the return of investment, ROI, for investor at that time? Do you have any idea?
Yeah, I do. And let me add to a little bit of my story.
Mm-hmm.
So when these properties were bought, these properties were bought not by a syndication model. They were bought by, and I'm going to use an example of 3 rich guys or 3 rich ladies. And that's how these deals were done. It was the operator, his brother-in-law, and then the rich guy. And then the three people that bought these deals. And so occupancy in these properties were 95%. The people that were buying these properties, they were buying for long-term passive cash flow. They weren't buying them to flip them in 18 to 24 months. They wanted to hold on to these things for a long period of time. And so it wasn't until like 2000 and let's see, today's 2023, say 2011, 2012, That's where we started to see the syndication model come out. So that we go back, 90% of the transactions prior to, say, from 1940, 1950 to almost to 2000 or so, those were all done with the three rich guys, 90% that way, 10% syndication. In 2011, it flipped. It became 90% syndication, and now it's almost 100% syndication in the models that you guys work within. The properties have gone up in value so much. And so if we go back to like 1984, 85, the average price in these properties for a brand new Class A property, and a brand new Class A property at that period of time was probably about $72,000 a door. Individual HVAC, pitched roof. Think of those properties off of Jupiter and 635, and I'm just giving that as an example. Those properties were about $75,000. Today, those properties are probably about $172,000 a door. But the main fuel that was put on this fire was the syndication model and the ability for people to raise money. And Fannie Mae did not like that prior to 2011, 2012. They could not understand how unrelated parties would bring and pool their monies together. They just couldn't understand. They were like, well, what happens if there's a problem? Let's see, on these deals, who's going to step up and pay a deficiency balance? Who's going to step up and put more capital into these deals? These are so fractional properties these days. We need to find a couple of those rich guys within the partnership itself that will support the transaction from it going under. And we were able to make some arguments that we were able to try to have Fannie Mae kind of understand that. And for the last, say, 10 years, it's been a unbelievably sweet ride. And now Fannie Mae is a little bit doubting a little bit about this partnership structure within the syndication model, because they're starting to see some stress on some of these deals. And we don't have a lot of people that are stepping up and saying, I'll put in additional cash for these deals. Now, these properties have gone, as I said, from $75,000 up to $170,000. And during the recession of, say, 2008, 2009, there were properties that, say, in Irving that were selling for $18,000 to $27,000 a door. So, everything is kind of relative right now, but my concern is that a lot of these partnerships are having difficulties that have been formed in the last, say, 2 or 3 years, especially not so much the property itself. Now we've had taxes and insurance, and that piece and interest rates go up, but it's really been the structure of the loan that's been really the difficulties in these last number of years. So prior to that, a lot of people from, say, 2011 to, say, 2020, 2021, we just did Fannie Mae, Freddie Mac fixed rate financing, and that was it. Interest rates were up, we're down, but we did fixed rates on those loans. And then what happened is that everybody started to get into multifamily. All you guys are, I would say, are fairly new to multifamily if you've done it for 5 years or 10 years. And we all put money into these deals because I'm an investor just like you too. And then these deals started to trade just like stocks. So instead of real estate, with a lot of people held these deals for 10 or 12 or 13 years. Now we were starting to see in 2014, 15, 16, 17, these deals were starting to turn every 18, 24 months, 36 months in the deal. And so then with the fixed rates, we had yield maintenance penalties. And a lot of people were like, I don't want any of that yield maintenance penalty type of stuff. Give me something that has an easy out to get out of the loan at a cheaper price. And then these non-recourse, high leverage, adjustable rate loans came in from 2001 to 2022. Even 2023, we're still seeing some adjustable rates on the bridge side. So if you go back, 10, 12 years, it was fixed rates. In the last 3 years, it's been adjustable rates. But if you've had, a lot of the transactions that we're seeing today are a lot of assumptions on the Fannie Mae loans that were done, say, 3, 4, 5, 6 years ago, where the people were required to put down 35 or 40%. in the last 3 years because everybody feels that the mountain was not climbed high enough and everything was going to go to the sky. They only had to put down 20% with the momentum kind of going up behind it. So they put down as little as possible. They did some of these transactions were, non-recourse adjustable rates based on SOFR. And right now we're paying 8.5% to 9% on interest rates. We have to pay an interest rate cap to keep these payments. And if the partnership does not have enough money to repay for another annual payment on the interest rate cap, everybody's like, there's no money. What's going to happen here? So you've seen transactions down like in Houston, where Jay's property, the 3,200 doors went back after only being held for 12 months. So we're trying to prevent those type of transactions from going on or being available on this next go around. And so I think really the opportunity for the future is not so much the properties, but letting all these adjustable rate bridge loans kind of burn away, go away. Either they're going to be refinanced into, say, a FHA 35-year, longer term hold, or they're going to be. So there's three things that are going to happen to some of these bridge loans. I call it the 3-4s, or Ashley calls it the 3-4s. It is a foreclosure. It is going to be a forbearance, which is really paying the interest on the backside of the deal, or it's going to be a forced for sale. And so we're seeing the 3-4s that are going to be coming up. And I think that's where the opportunity is, where these properties are going to be reset at a lower price. And that's where you kind of have to back the Brinks truck up. And that's where the opportunity for the new level of investors to come in. That's where the options are going to be better coming up here in the near future.
So do you still think that 2x is possible in 3 to 5 years?
Double your money?
Yeah.
No.
See,
No way.
I'm agreed with you 100% because they are already overpriced. There is no way you can get 2x in 3 to 5 years. We did so many underwriting and we are just not able. What they are asking price is too high, right?
It's not even, see if it's not even close.
Yeah.
I mean, right now, cash on cash, what we're seeing is maybe, you could almost earn more money in a money market account and take the risk off the table. But there's a lot of things that owning real estate and holding it for a longer term, that's where you create your wealth. It's not by putting money into a money market account and having it grow at 4.5%, 5%, but there's other ways that you can grow your wealth. And so one of the things that I learned since I've been doing this for a long, long time, even though I don't look it, I'm old, that if you buy something like commercial real estate, like something that pays on a monthly basis, that if something happens as a tenant, you can that person's going to go away, and you can come in with a hose and hose the unit down and recarpet the unit and repaint the unit and put brand new appliances in. You can raise rents by $200 or $300 a month. I mean, that's possible, but what I'm not seeing a lot of is a lot of value-added properties that are being done right now. Most of the properties that we're seeing have a little bit of a value-added component, but mostly are stabilized properties. So the value add is going to come because we're going to see a lot of these partnerships have problems, and a lot of these properties are not going to be maintained. And the cities are going to come in to say, hey, listen, get your act together and fix this property or sell it, or we're going to fine you. And then that's, we're going to start to see occupancy fall apart. And so that's going to be the next domino fall. Is we're seeing areas like Arlington have some issues. We're seeing areas of like East Dallas going to Mesquite having some issues. So there are some areas that I think we're on these Class C properties are going to get hit worse than the Class A- or B+ properties. So I think the capitulation has happened in the A's, A- properties, B+, but it has not happened in the B- and C's and the C+, definitely the C-. You're going to see cap rates go up tremendously. So that's
Thank you, Paul.
That's my 2 cents.
Thank you so much. I have another question here from the audience. if you could please explain to us what is SOFR in layman's term and how does it affect interest rates and how is it calculated?
Yeah, so SOFR is overnight borrowings. And so we used to have a thing called LIBOR, London Interbank Offer Rate, and that went away really for the last 2 or 3 years. And SOFR is kind of the replacement, and it's really through the Bank of New York, and it's what good banks overnight charge each other for deposits to make sure that they meet their capital requirements. And so short-term rates are the ones that are what SOFR is all about. So they can change that just kind of based on inflation. And so the long-term rates are based on expectation of inflation. And so fixed rates like the 10-year and 12 years and Freddie Mac and Fannie Mae loans typically are based on a 10-year long bond. And then the short bridge loans are based on SOFR because it can change rapidly. It can change month to month. And so a lot of these adjustable rates that have been based on SOFR, that's why it started off back about 2 years ago, we were at 0.05 as SOFR. That's what banks in between each other were charging each other for overnight funds. And now it's up to 5.32.
Wow.
That's
Yeah.
a big difference.
So now add another 4 to 4.5% above that. So if we're at 4.3 or 5.32 plus 4.5%, Asif can help us do the math. That's a big number that you would be paying on a $20 million bridge loan. So that's what our issue is that these adjustable rates based on the SOFR have gone up so quickly over a period of time that it's going to put a lot of these properties out. Now, remember when I first started off, Paul Volcker was in charge, not Jerome Powell, and he raised interest rates in one day 5%.
Oh,
We've had it over a period of 12 or 13, 14 months. And, we can go out and take a look at different curves of where we think expectations of interest rates are, but I don't think anybody knows. I mean, as Ashley says, we're going to be right one of the 3 times. Interest rates are going to go up, they're going to go down, or they're going to stay the same. And nobody really understands where that is. And if they start to go down, they're not going to fall off the cliff and go down. They're going to go down, very gradually and gently. And so I would say what you want to do to get smart, you want to read a gentleman that we have on the podcast all the time, JP Conklin at Pensford. Pensford.com, grab his weekly newsletter. And this guy is the best of the best. And he's not an economist, but he trades interest rates, and he provides the interest rate caps for us, the lenders, and for you, the borrowers. And he kind of has an insight about what's going on. So read his up-to-date newsletter about what's happening.
Oh, thank you, Paul. Did you say J.P. Conklin?
Yeah, JP Conklin. Just go to Pensford, PENSFORD. PENSFORD.com.
Thank you. That is valuable information for our audience.
Can you
What
repeat
about
it one more time, please? Did you say PENS?
Yeah, PENSFORD.
That's for. Thank
Yeah.
you.
Pensford.
So
Thank
can
you,
we
Paul.
set up the floor? Can we set up the floor rating? Floor rate for the mortgage or interest that, okay, this is what our floor rate.
Can you put a floor to the interest rate?
Yes. Like, cap that it cannot go up more than this.
Yeah, most lenders are not going to allow you to do that. Now, there are some lenders that will say, hey, listen, we're going to give you a kind of a governor between, say, 5 and 7% or so. But that's only 1% out of 100 lenders that are going to allow you to do that. And they're going to probably require you to have a $40 million mortgage or above, that they're going to take the risk if in case interest rates go higher. But depository institutions that are going to be recourse loans, they're not going to take the interest rate risk. They want you to take the interest rate risk.
Right. That makes sense.
Herb,
Okay.
get ready, man. I got one rich person, Herb.
Right.
Yes, that's right. Herb is very rich.
All right. Thank you, Paul. There's a few questions that you already answered as far as the future market on interest rates. And also, I had a question from the audience of how does the Fed determine interest rates? I think you pretty much explained that, but do you have anything to say about it?
So they come out, I think 8 times a year, and they make ideas of where they're going to raise interest rates by a quarter or a half, or going up, or a quarter or a half going down, or they just keep it the same way. So they're looking at just different inflation factors of what can affect the consumer prices. And they're trying to make sure that we only have an inflation factor of 2%. So if things are going up to like 9% of inflation, they're going to try to slow the economy down. And that's one of their switches that they can go back and forth on. So if interest rates are going higher, they know the economy is going to slow down. Just like right now, borrowing has started to slow down because interest rates are higher. Sometimes it can be challenging to find jobs because people, with interest rates going up, people cannot borrow, businesses cannot borrow money for capital machines. So that's why they slow the economy down. So, that's what the one thing that we look for when we have, fixed rates, those are based on the 10-year treasuries.
Thank you, Paul. I have another question here. What types of loans are most likely to be approved in the current market, like for commercial real estate, apartments specific?
Yeah, mostly Fannie Mae and Freddie Mac loans, and Fannie Mae and Freddie Mac are not bridge lenders. That's not what they do. They don't look what the property is going to be in the future. They don't base their loans on pro formas. They base, if this was a car, they're looking in the rear view mirror and how your drive has been in the past. So they want to see what it's done. What'd you do with the last month, the trailing 3 months, the trailing 6, trailing 12 or 18 months. They're looking for a stabilized property, and they're only going to lend on a non-recourse basis, stabilized properties. And right now, we're probably requiring, even though our rules are we can go up to 80% leverage, these properties have gone up in value so much that the NOI is only giving us about 65% leverage point. So with Fannie Mae, we're only getting 65% leverage on these deals, and that's probably max. Now, in some places and throughout the United States, we had a deal up in Minnesota that got up to 80% leverage. But so the price must be lower than what a lot of these properties are in Texas. So probably the easiest one to get right now is a Fannie Mae loan, but it's going to require a lot of cash into the transaction. And remember, we want positive leverage in these deals. So right now, Fannie Mae loans are, let's say, are 6.5, 6.25, 6.5. So you have to be at 7 of a cap rate for it to have positive leverage. And I would tell you, let's go out there and find as many 7 caps as possible. And right now, it's challenging for the A-, B+, but it's definitely there with the C's, and it's going to get even worse for the C's in the future. And I'm talking about the older C's, the properties that go back to 1960s, 70s, and probably the 80s are going to go up to past 7 on the cap rates. They're already there right now.
They're already there, yeah.
Yeah, thank you. Thank you so much. Are there any other questions from the audience? Sanjeev, Edward?
Is there anything that I missed that you would want to say?
Yeah, give us a assumable loan deal.
What's that?
Assumable loan.
Yeah, assumable loan. I mean, right now, a lot of the assumable loans are 3.5%, 4%. I mean, that terraces on the Parkway over in Grand Prairie that the Sharmas are selling, where there's a buyer, and that's a 3.5 remaining term of that loan is, I think, 7 years.
Yes.
Or so.
I have a question. Somebody came to me, right, and they have an apartment, right? And it's what they're saying that it could be assumable loan if you buy 80% of the entity. The existing owner want to stay with a 20% shareholding, and they're saying, I'm going to buy the company, I'm buying their corporation, right? So the bank or the lender will allow you to be continue same interest rate, which is 3.04 for
Yeah,
eight.
they probably won't allow to keep the count. They probably will not allow you to keep the LLC in place. But what they'll probably let you do is assume the loan that's currently on there. And, it's going to be a sale, and they'll allow the seller to become a limited partner in the deal. So they'll flip their equity out on their side,
Mhm,
collapse that LLC. The
mhm.
new buyer comes in and will bring in whatever the amount of equity. The limited partner, who's the seller, will bring in their 20 up to 24.99% equity, and they'll be just a limited partner in the deal. So
So
try to
is
buy
it-
these corporations a lot of times is not the best idea to do, because Fannie Mae does not like that at all when you're buying corporations or using somebody else's corporation on that.
Because somebody is teaching them, a broker or somebody. So
Yeah.
I'm seeing that some of the deals are coming with that idea.
Yeah, that's not right. That doesn't work.
Okay.
Okay. Thank you. Thanks for the information. Any other questions on here for today?
No,
I
I
have
would
another.
just
Yeah.
tell you that right now is a time to pump up the market, to build your relationships with people, to bring in new equity into this business. And I will tell you that a lot of people that got into bridge loans for the last, say, 2 years or so, they're going to suffer some heartburn. And so to keep this market going, we need to have new equity being brought in to support these deals. If new equity is not coming in, and there's going to be a lot of inventory that's going to hit the market, we're going to see property values collapse.
And that's the
So if
biggest problem we have. We are not seeing the property values are going down. There is still asking pretty good high.
Yeah,
And based on
there's
the
a disconnect
performance.
there's a disconnect between the buyer and seller.
Yeah.
But there's limited inventory, so we can't really make a market with limited inventory. But I will tell you, on some deals, I mean, you can kind of go through the list. A property like Brookside over in Arlington, as an example, it's a deal that XYZ LLC company bought that deal back about 3 years ago. They put $3.5 million or so into the property with CapEx. They took out a bridge loan. Now that property increased property taxes, insurance. They weren't able to hit their debt yields. And so they have to come up with another $1.5 million for an interest rate cap. And right now that probably the best that they're going to be able to get. Now they bought it for 38 plus 3 million. So $41 million all in is their cost of the deal. They'll probably get 32 or $33 million on that property. So we are seeing values fall. Yeah, significantly. So just keep an eye out. There's a lot of companies out there. You'll see it on The Real Deal, or you'll see it, something come up on LinkedIn of deals that are struggling. But trust me, there's a disconnect between a buyer and a seller.
Oh, yeah. Yeah.
But
Big.
that's today. Tomorrow it will be completely different. The
Paul,
seller will say, "I'm out of here. I have no more money, and I don't want to be foreclosed upon. So I'm going to start, if I have any equity, I'm going to go right to guns and sell."
Paul, do you know any deal which is struggling in Dallas area?
Every deal, Sanji, is struggling in Dallas. That's on a bridge loan.
Okay.
It's not like one or two deals. It is every deal is struggling on bridge loans. So it's not again, we talked about interest rates have gone up from 4% up to 9%. That's a huge rise on a $20 million deal. Nobody has an interest rate cap. They don't have $1 million to put in to keep this property going. Property taxes have gone up. They don't have the money to do it. insurance has gone from, we used to underwrite these deals at $350 a door in insurance. Now they're at $1,300, $1,400, $1,700 a door in insurance.
Correct.
So Sanjeev, every deal is getting the shit kicked out of it. So, this is what I'm saying. Raise the money right now and back the Brinks truck up as much as you can, because these deals are coming. They don't look like they're doing right now, but they're coming.
Okay.
I
So-
see what you're saying.
So elaborate something like you say, hold for long term, right? So right now, currently people are holding 3 to 5. What do you think of hold for long term? Is up to 10 year?
Yeah, Asif, that's used to be the way it was.
10 year, right?
Yeah, if you go back and you talk to any US investors from the 50s, 60s, 70s, and 80s, they own these deals for 10, 12, 13 years, and they were passed down to their kids. People today, for the last 3 or 4 years, they've been trading these deals like E-Trade.
Oh,
You know, you talk to some of these folks, I mean, it is wacky, and everybody expects to get that 22% IRR on the deal. That's not the way it is. Come on.
Right.
It's I go with the game stupid or liar. So, don't believe the 22%, and look at all these pro formas that people put out there in their PPMs from 2 years ago, even last year. They're not going to hit that stuff at all. They're going to be way off. So, I mean, I'm writing a letter.
How they're going to save the property if they really would like to stay for next 3 years? Because not all the people want to really do the foreclosures, right? So what strategy they have to adopt to survive?
Raise more money internally with common. So people say, well, listen, there's this fund out there. It's a preferred equity piece that, a rescue capital deal that, we can't raise any more money. Then if you can't raise any money, sell the deal. I mean, get out. And you may throw all that equity of people's money away, your general partnership override away, it's gone. But if you have a foreclosure, you're not going to fight for another day. One of the things that you have to ask, that the lender asks for, have you had a deal to a foreclosure or a foreclosure? And if you say yes, you're out.
So all the LPs are going to lose the money.
You bet.
Yeah, Paul, I have one more question before we wrap this up from the audience.
Mhm.
And it is, Chatham shows IR would fall, but currently it's still high. So what kind of financing would be good for us in multifamily? Did that make sense?
Nope. So
Okay.
one more time.
All right. Yeah, Chatham shows IR would fall, but currently it's still high. So what kind of finance should be good for us in multifamily? That was the question.
So take a long-term perspective. And I think Asif says that and Sanjeev says that too, is take the longer term perspective. So financing should be for 5, 7, 10 years minimum, not for 5 years with these 3-year adjustable rate bridge loans with these 2-year, 1-year extensions that go along with it, that you have to pay the interest rate cap. Ron Popeil, which you don't remember, but he had a thing where he'd put this chicken in a machine and it would roast his chicken. And he would set the thing and he'd turn the thing and he'd say, set it and forget it. And 20 minutes later, an hour later, he'd come back and the whole chicken would be roasted up. It would just be beautiful golden brown. That's the same thing I'm telling you to do right now. Put a fixed rate on there, set the deal and forget it and move on. And you may say, well, we make the decisions on the front side, whether we should do a 5-year or a 7-year, 10-year loan. The shorter term, the higher the interest rate is going to be. So you have to go with the perspective of what's my exit going to be on this transaction and set the right expectations on what the term is going to be. If you're thinking of only being in this loan for 5 years, don't take a 12-year loan. you're thinking about being here for 7 years, maybe take a 10-year term. So give yourself, some ability. So, interest rates come and go. Property management companies come and go.
Paul, you may be broken up there a little.
I think we lost him.
Yeah.
Yeah.
But
Well,
it
that
is
was
very interesting, man. It's an interesting discussion. We all need to be careful before we burning relationship with investors.
Right. That's very valuable information and background, especially in this Dallas area, as Paul was giving us a very good background, a
Yeah.
long-term background.
I'm worried about my investment
Yeah.
as LP.
Right. There you are, Paul.
I'm right here, bros. So where did I end? Sanjeev, where did I end?
You were talking about long-term investment.
Long-term investments. Let me do it one more time. December 7th, 1941. Did I say that?
No.
Okay. December 7th, 1941. October of 1987. September 11th, 2001. 3 years ago when COVID happened. These were all times that challenged the American people, American economy. Don't bet against the American economy. Stay the course. Stay in these transactions. We may have occupancies go up, they go down. We may have presidents go in, go out. We may have interest rates go up or go down, but just stay the course. Take a long-term perspective on these deals and just keep going. It's my 2 cents.
Okay.
I know maybe that's Ashley's 2 cents too. Ashley, is that your 2 cents? There you go. I love it.
Agreed. I agree.
Awesome.
So when we're out there teaching and we're talking to people, you got to get them off I'm making 22% of my money every 2 years. Because that's not going to happen.
I
Now
can see.
it may, it's not going to happen. I mean,
Mm.
it all goes back to, again, this syndication model. And I hope we make it through this next go around that Fannie Mae doesn't shut the syndication model down.
Oh, you're thinking that?
Yes.
Oh.
I'm not saying that. I'm just speculating because, I mean, you got a group of a bunch of investors. Let's say in a typical Brad group, we have 100 investors in a deal, or 130, 150. How many people say I'm going to do the capital call? How much money came in on that type of stuff? Everybody sat on their hands. Why do I want to put good money after a bad investment? So then Fannie Mae is like, well, there goes that idea that we're all sticking in this deal together. Maybe they won't. So we'll have to figure out, Fannie Mae only wants to rent the money. They don't want to own the real estate.
Right. I understand what you're saying. Wow.
Yeah.
That's amazing.
So my bad news is the last 3 years, it's been a cluster. It's going to be a cluster right now, but going 3 years from today, you'll be glad you invested in the next 6 months, 6 to 8 months, because that's where it's going to come off the cliff and come right down. So back the truck up, try to find as much equity as possible and tell a different story than what you've been telling for the last 3 years. Work on your story presentation.
I like that. Thank you. That's a good shift for me. Thank you, Paul.
No problem.
Thank you for sharing with us the background and the long-term background of the Dallas area as you did. That's very helpful.
Yeah, Ashley has the kind of one of our white paper presentations that we use that on. And remember, don't forget about the Old Capitol Conference coming up here October 4th and 5th. If you've never gone to it, it's a lot of fun. We're doing it at the Frontiers of Flight Museum in Dallas, next to Love Field over there. Last year we had it at Texas Live. The year before we had it actually the ball field on the grass. Year before that, I think we had it at House of Blues. The year before that, we had it at Jerry World over at Dallas Cowboys. So we do these large venues and we have, 500-600 people show up for that.
All right, I see the link in the chat. Everyone's welcome to get that link and attend this amazing conference that Paul and his company puts on in
That's
Dallas.
it.
It's
All right,
worth flying
before-
in town for.
It is. Before my screen freezes again, is there any other questions?
Anyone?
If not, I'm going to jump off. I think Ashley is going to jump off, but we appreciate everybody's time today. Again, Old Capital Lending, you know us. I mean, we do 1 out of every 3 apartment loans in Dallas, Fort Worth, Austin, San Antonio. So we know this market. So
Thank
we
you so
appreciate
much, Paul.
we appreciate your time today.
Very helpful.
Thank
Bye.
you.
All right, guys. Thanks.